Hi, good afternoon, everyone. We are privileged to host you for another Netra webinar today. It's a household term, I believe, Netra now, the term which we've used to show early warning and signals in the financial markets. As we stand today, we have the RBI policy coming in tomorrow. We have Fed, which was read as being hawkish after the last policy. Again, growth concerns. India's data is very, very robust, but the narrative is that of a slowdown. So decode all this and more, and what it means for your investing journey, which are the sectors to watch out for, how can you do your asset allocation better, what are Indian equities looking like, and where should you be investing your money. We have none other than Sahil Kapoor presenting the Netra to us. Sahil has been diligently writing Netra on 5th of every month for last 1.5 years now. It has been widely read, and we've all learned a lot from this offering by Sahil. So Sahil will run us through each and every slide in detail. And please use the question box to ask us questions. After he's done with his presentation, we'll take the Q&A towards the end of the call. So over to you, Sahil.
Thank you, Ankita, and thank you everyone for joining in. And as Ankita said, we do this every 5th of the month, and we come out with a set of slides, a deck, which will give you an insight into what we are looking at. So you can go and access this on the website, on the DSP website, and you can access this updated report, or you can also refer to the social media handles. So today I'm going to talk about the latest Feb edition of Netra, and we'll talk about several things, and I will keep it short, spend a few minutes on each slide, and then probably we'll take Q&A at the end. So as Ankita said, please write down your question as and when I'm talking. For those particular slides, you can go and write those questions at that point in time so that you don't forget. We will use those questions and try and answer all of them put together. So I'll share my screen and we'll start from there. So as you know, this report is a culmination of various aspects that we look at. We look at a number of indicators all at the same time. And many of these indicators become relevant at different points in time. And we try to, use them or use the most relevant ones, which we feel are important to be reported in that particular month. So this month, we've come out with a list of things which are important. And I'm going to talk about growth. I'm going to talk about valuations and certain opportunities which we think are very, very important. So first, let's look at Indian economic data. And we look at some data points which are a little high frequency in nature. And they tell us, they give us ideas about various parts of the economy. So for example, the topmost left chart gives you an idea of how GST collections are going. GST collections per se gives you an idea of the overall sense of the economy, how fast is it growing. But of course, it takes into account inflation. So when inflation is high, you will see that GST collections usually grow at a faster pace. But at the same time, total e-way bills, which is a number which comes in, exact number of bills generated, that is a reflection of how robust the overall economy is, irrespective of the level of inflation. So you can see that both these numbers are headed higher. Number of e-way bills generated are at lifetime high now, which indicates that the economic activity remains quite robust in the economy. Second is the volume of petroleum products sold. Volume is irrespective of the price. Higher price usually dents the volume a little. Lower price usually should increase the volume, but we've seen that oil demand in India is very inelastic. It doesn't really change very fast, even at extremes. So you can see that the volume of petroleum products sold, which is the proxy for demand, is again headed at lifetime high numbers. The reading that we had last month, which is the month of December, the data was out. That reading was one of the highest reading, or the second highest reading that India has ever recorded for any particular month. So again, a robust set of numbers. Also encouraging to see that this number is following up even after the festive season is over, which means that the overall economic trajectory is still positive. It's growing. Third is electronic toll or FASTag collection, again, which remains at all-time high. Usually this number should always be at all-time high, growing briskly. Whenever there are dips, you can assume that these dips are either probably because of certain disruptions or probably economic activity is slowing down. So usually this number should slide upwards, inch upwards slowly, and that is what it is doing. And fourth one is the business activity index. You can see that both manufacturing and services is well above the 50 mark, which tells you that it is in the expansion zone. And this expansion is probably continuing. On the first of this month, we had manufacturing data, which came a tad lower at 55.8, which is still very, very strong. It's a data which is reflective of, expansionary moves in manufacturing, and services sector is also expanding. So on the whole, the conclusion from the slide is that most indicators, most economic indicators are still pointing to steady growth. There are certain concerns that because of global slowness, our economy could also face a slowdown. But as of now, we haven't seen that in numbers. If you remember, about 6 to 9 months ago, there was a certain debate whether there is decoupling or not. And we took a stance that it's very hard to predict these terms, whether the economy will decouple or not decouple. So it's good to look at data, high frequency data. Till the time high frequency data tells you that growth is steady, you stick with that argument. And for now, we see that growth is steady and Indian economy is doing well. Whether a global economy is slowing or recovering, Indian economy is steadily improving, right? So that seems to be the case even now with all these data points. Second is, where are the valuations? And we put forth a number of indicators. One is market cap to GDP. I'm not a great fan of this indicator, but it does tell you, extremes at certain point in time. So we reached an extreme of over 115% in 2021. We've slid down to about 99% market cap to GDP for India. Market cap to GDP for US is 157%. It had gone above 200% last year, right? So it has gone down now. So these numbers have come down, but still they remain high. Indian market cap to GDP on an average is at about 70 to 75% range. So we are quite away from that number, but we have come off from the very high base that we had earlier. One very important input in market cap to GDP is that when you look at the mix, you have to understand where the profits are coming from and where the market cap is right now. So for example, in case of US, almost 47% of S&P 500 profitability comes from companies making revenue outside of United States. That means the market cap associated with those profits has got very little to do with US GDP, right? So the market cap to GDP number will always be skewed. So it's a number that you have to take with a pinch of salt. But nonetheless, this has been coming lower. And once this number falls significantly, it usually gives you an indication. Right now, this most likely is not a great indicator to judge where we are in the cycle. Second is the US money supply. And you can see that money supply in US has been deflating, slowing down. The orange line is the US money supply. You can see that it has come down over the last few months. And this is the YOY growth number, right? And we have now slid down below zero for US money supply, which means that it has started to decelerate or reduce year on year. And at the same time, valuation parameters, both for India and US markets, have come down. So for example, NASDAQ from a peak multiple of about 37, it has come down to multiples of about 22, 23 now. And same is the case with Nifty, which, peak multiples of 25, 26 has come down to 20.5 trailing multiples. So there has been a reduction in the excess valuation that we had in the market, and which is reflected in how it has happened over the last few months. And third, again, very similar indicator, you can see Nifty PE ratio. This is on a forward basis, is at about 18.7 now. We had some more correction. So on exact basis, Nifty PE 1 year forward basis is close to 18.5 today. And the long-term average is at about 17.9. And price to book is at about 323 or so. Long-term is at about 3. So we are now approaching average valuations on the index. We are not very far away from that. In fact, just to give you a sense on numbers, how to think about it. So if you look at the NSE data, Nifty EPS, the trailing 12-month EPS as of yesterday's close was 855 rupees, right? So by the time we end this quarterly earnings or the Feb end happens, Nifty EPS will be around 860 to 85 or 865, right? So if it is at 860 at 20 times trailing earning, a level of 17,200 comes for Nifty. And when you look at past data, there are very few financial years where Nifty has closed below 20 times trailing multiple, right? So give or take 17,000 becomes a new base for the Nifty. And if you are between 17 to 17,400 kind of a range, it does make sense to look at equity allocation, probably increase those equity allocations. On the bear ratio or bond yields to earning yields, we are again very close to the averages, not very far off. So no great signal value per se in these indicators, but they do tell you that we are not running in excessively expensive markets, neither are we in the cheap zone, right? So the best idea is that at average or below average valuations, you should have average or slightly higher allocation to equities, and that is what we are looking at. And then the next step, of course, is to go down and look at each sector and segment and take a more informed decision. These are just headline decision based on where indices are trading. Third and very important chart is the India premium over emerging markets. This was a very, very talked about indicator just about a few months ago. You can see in mid-October, India was trading at 3 standard deviation above its long-term average in terms of its premium over emerging markets. So what this ratio shows is Nifty PE divided by MSCI emerging market PE. So when you look at the ratio, how far are we trading from the average? So the long-term average is 1.41%. In October, we were trading at 1.89, 1.9, 1.89, which was 3 standard deviation away. I have marked it here. And in the last 2-3 months, what has happened is emerging markets have rallied between 25 to 50%, given whichever market you look at. The emerging market index has rallied about 28%. And India has done nothing. So 3-month change is 0%. And plus our earnings have gone up to some extent. And the combined effect of all of this is that our premium over emerging markets have declined significantly. And we are now getting closer to average. We are still one standard about a standard deviation from our average. But you can't really predict whether it will go to average, below average, or stay here or go higher. The key point to be made is that the excess premium that we were enjoying, that has gone away. And that was also a deterrent for FIs to continuously put money in India. And I think with this correction setting in place, it makes all the more reasons for FI not to continue with their selling in India and probably look to buy Indian equities. And so in the last version of Netra, if you remember, we had made this outlook that in the calendar year 23, FI could be net equity buyer in India. And I think that will play out over the year. We already have seen this valuation coming down. Plus, I have given a number of factors in various other previous editions of Netra. And I think most of those will likely play out over the year. And you will see, valuations being very, very juicy once we get below average valuations. And what will be the function of this below average valuations? Likely continued rally in emerging markets that is possibly going to cause India to look average or below average in terms of valuation, and that will make us more attractive. So the conclusion is the excess premium froth is getting washed away. Large part of it is already gone, and this will help FIs return to Indian equities. And I think by the end of the year, we should see that play out. Also, I've added the view that I gave you in the last slide, that with an expected EPS of between 980 to 1,000 in 2024, raising equity weights as index near 17,000 to 17,400 could be beneficial. And we were there, I think, about a day ago or 2 days ago. And today also, I think we were at 500 or something, 550. So we are close to that range, and it makes sense to look at equity and raising equity allocation. Another important opportunity which I want to talk about, so I spoke about growth and valuations, I want to talk about a few opportunities. So one is this corporate bond yield spreads. We've seen that they haven't really expanded. So if you look at this chart, whenever RBI has raised rates, corporate bond spreads have gone up. What are corporate bond spreads? So whenever corporates borrow, they usually borrow at a premium over GSEC yields. For example, if GSEC is at 8%, corporations will borrow at 8 plus. So either 8.5 or 9% or higher, depending on whether they're AAA, AA, or lower category paper, right? Lower rating paper. And whenever RBI raises rates, we see that yield spreads expand. And if you can see that historically bond yield spreads have been closer to 70 to 110 basis points on an average. Right now, what we are seeing is that AAA spreads, you can see, they are depressed. They are close to their all-time lows, and they haven't really expanded even when RBI has raised interest rates, right? So people who have attended the earlier sessions will remember that we showed a slide last time saying that this monetary policy or this tightening cycle that we are seeing, RBI is raising interest rates, is one of the least disruptive. We haven't seen rates go up as much as they do in the past cycles. For example, in this cycle, rates went up to 8.5%. Previous cycle, they went up to 9%. In this cycle, they have gone up only at to 6.25% up until now, and yields have gone up even less. Right. So what does it show? That rates have gone up less in comparison to past cycles in magnitude. In the pace, they have been much higher. And secondly, our interbank liquidity has been it's still positive. So liquidity hasn't been squeezed out of the market completely. And third, and here another aspect which I brought today in this slide is that corporate bond yields have also not become very, very high. So if you put all the 3 points together, rates are not as high as previous cycle. Second, liquidity conditions are better versus the last hiking cycle. And third, corporate spreads are also not very high. What does this mean? This means that corporations are able to borrow the environment is better for them to borrow even during a tightening cycle, and the rates are also more conducive. Okay, so which means that when RBI pauses or reverses its monetary policy, companies will benefit a lot more from a more benign regime, more benign monetary policy, and this will have very positive effect on India's growth. Right? So this probably will play out for the rest of the year, and we have to watch this very carefully. Last 5-7 days where this whole Adani issue played out, we haven't seen corporate bond yields spike significantly, which is again an indication that the market-wide impact has been much lower or mostly absent. Because in market routes like these, usually the bond market panics for lower quality paper, and we've seen that has not happened. So again, a good indication overall. So the takeaway from this slide is corporate bond yield spreads have not gone haywire, which shows that market is not in a panic mode, which also tells you that market feels that duration play or probably falling of interest rates going ahead is quite a possibility, right? The next slide is, what do you do when interest rates peak out? So taking a leaf from the last slide where I spoke about that there is a possibility that rates might go down or yields might go down. Rates may not be the best word to use here. So when RBI pauses or begins to talk about a more neutral monetary policy, you will see that yields will stabilize or probably start falling. At least the initial reaction will be that, right? So whenever we see that the monetary tightening cycle ends, we've seen historically that constant maturity funds outperform all the other strategies. And why does this happen? So I'll give you 3 very, very important points. And I'll also give you which strategy to follow. So first is that when you see that rates have peaked out and they are most likely to stabilize or fall, if you go for a constant maturity where yields are high, for example, a 4-year maturity, which is what we are looking at today, you will get higher accrual. So when rates fall and you continue to remain at higher maturity, which is 4-year, you will get a higher accrual, higher rate of interest because you will hold higher maturity, right? Second, you will get a better duration play because you continue to hold higher maturity paper during falling interest rates. Third is you could also add an active component to this strategy. That means take an exposure through an active fund. Why does it matter? Because active fund will be able to transition between AA, AAA, and GSEC. And during falling interest rates, you will see that different rating papers give you a better maturity profile or better yield profile. So that is something that you have to keep in mind. Third, and the most important aspect is taxation. So when you construct a constant maturity profile or a strategy by buying a target maturity fund and then selling it the next year and then again buying a 4-year. For example, you buy a 4-year maturity paper today, and then after 1 year, it will become 3-year, right? And then you sell that and again buy a 4-year. There is a constant tax outgo which will happen every year. In case of an active constant maturity fund, that will not happen, right? So it is more tax efficient. So we feel that over the next few years, constant maturity, particularly in this 3 to 4-year bucket, would be one of the better strategies to participate in the bond market. And we are playing this strategy, and we'll come out with suitable ideas. And I think this is something which is a great opportunity to look at. The next slide is on IT stocks, and there has been a lot of debate about whether IT stocks is cheap or expensive, whether they should, whether you should look at these stocks or not. So what we've seen historically is that IT stocks usually, are better purchased when they are trading below their average valuations, right? And usually what we see is that post-COVID, valuations for IT and technology companies went through the roof, right? And over the last 1 year, we've seen that valuations have corrected. Both NASDAQ and NSE IT, you can see the black line is NSE IT, the blue line is NASDAQ. Their valuations have corrected significantly. For example, NASDAQ valuations peaked at about 35 times. Nifty IT valuations peaked at about 37 times. And both are now down between 27 to 25. In fact, Nifty IT is now cheaper than NASDAQ. You can see the black line is now below the blue line, which makes it more attractive than NASDAQ. But on the whole, they are still a little expensive than their long-term average valuations. So which means that doing a SIP now at this stage makes more sense rather than doing a lump sum in this sector. And probably it will become cheaper as we go forward. As the world slows down, as you see, US slowdown pan out, and probably 1 or 2 slides I'll talk about later. I think there is a possibility that this sector will remain in a churn. It will continue to see a grinding move over the next few months. And that is where you should participate in this sector through a SIP, because it is still not cheap. It is still not below average valuations. The next is an opportunity to own banks and autos. Some of you will be aware that we came out with a similar chart last year in about March, April, where we said that the opportunity to own banks and discretionary autos is much stronger than owning metals. And recently we saw a very strong rally in metals and this ratio coming back into play. And why does this ratio make sense now? So there are 2 angles to it. One, internationally linked sectors like commodities, which is metals and energy, will probably face a little bit of brunt from global slowdown, which is underway right now. And we've seen that prices for these commodities made a comeback, but some of them have again started to slip. For example, Brent crude went from $75 to 90 or 89. It is back below $80 now, right? 80, $81. So they have made an attempt to go higher with China reopening and other reasons and narratives which were there in the market, but they have failed to do that. And these sectors are very closely linked to commodity prices. Secondly, we've seen that many of these companies are not reporting the set of results that they were reporting last year, while many of them have seen stock prices going back higher. Plus, when you look at, let's say, a banking index or an auto index, earnings are very, very strong. Secondly, their fundamentals remain very robust. Third, for example, in case of banking, we've seen that it is trading at pre-COVID valuations or below pre-COVID valuations. So NSE Bank Index or Bank Nifty, as we call it, is trading at 1.88 times 1 year forward price to book, which is very attractive, much cheaper than the market. So in a sense, it makes sense to, buy the lenders and buy the consumers or discretionary consumption items rather than buying companies which sell commodities. So that is the play, and we feel that will play out for the next 2-3 years. And this again is a brilliant opportunity. In fact, there is a price pattern also emerging on this ratio now. When I was making this chart, this whole Adani episode had not played out, and the NSE Metal Index contains one stock which has a large weightage, and it will skew the most. Nonetheless, even if you ignore that, I think this is a very good enough intermarket scenario playing out, or intersector scenario playing out, which we feel that overweight strategies which are overweight on banks and autos should probably perform better than strategies which are overweight on metals and other oil and gas. The next is on India long-term numbers, and this I think is a very, very important slide, and it has a lot of data, and I want to explain some of the data points to you. One is that cities with 1 million population, you can see China has over 150 cities, 160 cities with over 1 million population. India has about 57, 58 now. In second chart, if you see the length of metro in China is close to 9,000 kilometers. In India, right now, it's less than 1,000 kilometers. It will probably reach 2,000 kilometers by 2025. So we are far away from where China is today. You can just look at this number and you will come to know what I'm saying. 9,000 kilometers they had in 21. We will have 2,000 kilometers in 25. China is 3 times India in terms of geographical spread, but it all depends on the number of cities, not just geographical spread, right? Third thing is installed capacity. So you can see that China has added in 3 years what we've added in 12 years. So if you look at the installed capacity of thermal and nuclear power in gigawatts, China is at 1,600 in totality, while we are at about 300 or so, which means that India is far away in terms of overall installed capacity. And the fourth one is that you can see the overall volume of trade which China handles. So if you look at all the Indian ports combined together, they have handled 19 million TEUs in FY22, while Shanghai port has handled 44 million alone, only Shanghai, right? So twice the size of India. So in totality, you can see that China is far away in terms of overall volumes, while we have to catch up. Now, there are 2 ways to look at it. One is a pessimistic way, that it's impossible to catch up with these numbers because they look very, very large and they require investments which we are not making, or at least financially we are not able to make as of now. Second and more important aspect is that India is making a progress in this direction, and we are seeing that slowly and steadily Indian numbers are catching up. We will not catch up at the pace that China has, because the investment that China made were very, very high because of the way they structured those investments. And second and more important point is that there is ample room for India to grow. There is ample room for these numbers to rise. So in any case, we have a blue sky scenario in terms of runway. Secondly, our direction is right. All these numbers are progressing in the right direction. And thirdly, with the budget now behind us, we are able to see that the capex cycle or government expenditure remains in the right direction. Those numbers are progressing in the right direction. We could do with much stronger pace. We could be happier if the pace is very strong. But as of now, the pace is not as strong as it should be. But overall, it is quite helpful. It is in the right direction. So the key takeaway, one, India has strong runway for growth. We are nowhere near the peak. Secondly, we are progressing in the right direction with all the numbers showing that growth and the intent for growth is present, right? And these numbers should give you a lot of comfort that there is a long runway for growth, right? The next slide is about US corporate profitability, and I'll give you 2-3 slides on US. So we believe that US economy is slowing down, although the latest job report, which is an aberration because of a seasonal adjustment, most numbers in US are showing a slowdown. Over the next 3 to 6 months, we'll see that US economy will slow down even further. So if you look at this There are two lines on this chart. One is the black background line, which has just turned negative. If you see very closely where my cursor is, the economy-weighted manufacturing and services sector, it has turned negative. And corporate profitability in US has also started to degrow from this quarter. So with this will have a, let's say, bearing effect on US equities. So for the next few months, you can see that US equities are most likely to remain in the range. We'll see that they will go up and down with this slowdown and this dynamic playing out, right? So there is a possibility that US markets will remain in a sideways move, in a broad sideways range, because US economy is still slowing down, and these effects will be visible over the next few months. This also means that inflation in US will slow down. And one more indicator that I put here is supply side issues. So we had supply chain, which were a big source of problem. And over the last few months, what we've seen is that these issues are now completely behind us. So what we've done is that we've taken an equal weighted index of various factors like freight, container freight rates, shipping freight, backlog of orders at major manufacturing, right? So if you look at all these, there are four actually underlying indices, two backlog of orders, one in US and one is in Taiwan. And if you look at these indicators, all of them have gone to pre-COVID levels. Some of them have actually fallen to seen pre-COVID, right? So which means that this supply chain issues which were prevalent last year, they have completely gone away or normalized. And this means that a mix of growth slowdown and supply chains easing will likely cause inflation to go lower. And this will force Fed to neutralize its stance. It has been hawkish and raising rates. Even in the last policy, the Fed said that it will probably raise rates going ahead. I think it will probably look at two more readings of inflation. One is on 14th of Feb, and then there will be a mid-March reading. And the next Fed meeting is on 22nd March. So if I hazard a guess, there is a possibility that market will take a look at these two data points, and then even the Fed take its decision based on these two inflation data points going ahead, rather than being on a preset course. So in any case, either Fed will hike one more time or stop. My sense is that it might actually have hiked the last time when we hiked on 1st of Feb, and we might see inflation going down. Nonetheless, if you look at statistically, the inflation data which will come out on 14th of Feb will not show a very large decline. It will show maybe a 30 to 40 basis points decline in US, which is not as large as it did last time because of certain base adjustments. But I think going from March, April, and May, inflation readings are going to fall very, very fast. And that will cause the monetary policy to shift gears at a very fast pace. So if you combine these two factors, that growth slows down, inflation slows down, so it can have two results. One, monetary policy hawkishness in US can come down. And secondly, even markets could remain sideways in US because corporate profitability is also slowing down, right? So these are the key takeaways from the last slide. So just to summarize on what I've said from slide number 1 onwards. So that we are seeing Indian economic data continues to remain steady. Second, valuations indicators are still mixed. We are getting close to averages. 17,000 or so plus minus, I think, is probably some sort of a base for Nifty. Between 17 to 17.4 is where you should look to increase equity valuations. You can't really be exact, but this is the kind of range that you can look at. India's premium is, over emerging market is going away. Again, a very positive sign. This will allow FIs to make a comeback. Third is corporate bond spreads haven't really gone up significantly. Again, I gave you 3 points here that rates are not very high in comparison to last cycle. Liquidity deficits are absent. We are still running a liquidity surplus. Third, bond yields are not very high. All these combined factors will allow corporates to borrow at attractive rates, even when we are in a hiking cycle, which should be positive for growth. The next is how to play if rates have peaked out, are going to go down going ahead. The best play is constant maturity funds, and I gave you 3 points for that, including higher accrual, better duration management, and better ratings management, and third is the taxation aspect. IT stocks still above average. Next 3 to 6 months, if markets consolidate, valuations come down, they will give an opportunity. So probably sipping and continuing to sip is a good strategy here. Still not very attractive on an absolute basis. The next is what is attractive. We think banks, autos, and some other sectors that we've spoken about, they are active and probably we should look at them. India and China in comparison, conclusion has said India has good, strong runway and probably should do better. We have the numbers, we have the ability, and we are progressing in the right direction. The next is a set of 3 charts which shows corporate profitability in US is slowing down, and this will cause markets to remain sideways in US for some more time. Supply chains have normalized, and therefore inflation should also come down, and this will allow central banks to take down their hawkish stance and probably become more neutral and sit on the fence. So with this, I will end here.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.